Hello, everyone. Stock market jobber Mark here, and I just want to give a little preview what I'm going to be watching in the market on Monday, the 27th, I believe. Yeah, the 27th. So it's kind of a tale of two markets going on here, and I think that what I'm seeing could suggest that we're about to make a move lower. Now, why do I say that? Well, you've heard about this stuff going on in the banks. And in a lot of ways, I think there's a chance that that's going to get even worse. And we'll explain that. I'll explain that when we get to the financials of the banks. But what's holding the market up, is technology. Now, at stockmarketjobber.com, we follow the S&P, and we also follow the 11 sectors that make it. So you have the S&P, it's kind of like what I call the mothership, and there's 11 sectors. We have technology, financials, healthcare, industrials, so forth and so on. So money has been flowing into technology. Now this here is an ETF, or an exchange traded fund. It's a SPDR. This is S&P depository receipt. So fortunately, there are these ETFs that let us track these sectors. Now you'll notice that we've been moving higher. All right. I'm just going to point out a couple of things here because I can't look at a chart without telling people what's going on. Notice here, see, this was resistance. Actually, I don't have my pointer on, so let me do that. So notice how resistance here became support here. Well, how does that happen? Levels that were resistance can turn into support. We saw it happen here. Resistance becomes support. Believe it or not, this happens because of seller's remorse, right? Whenever we look at a chart, we need to look at it through the context or the prism of what does it tell us about supply and demand, and what does it tell us about psychology. So why would a level that was resistance become support? Well, this happens because of seller's remorse, right? There are people who sold. When we go higher, they regret their decision to sell and they tell themselves they're going to buy their shares back, but they're only going to do so if they can get them for the same price they sold them at. So if we have enough remorseful sellers placing buy orders at the level that was resistance, the resistance will convert into support, like happened here. Now we see something else. Support can turn into resistance. This is the opposite. This happens because of buyer's remorse. There's people who bought here who regret doing so when the price goes lower, and they tell themselves they made a mistake, they want to get out, but only if they can get out at break even. So we have enough remorseful buyers placing their sell orders at a level that was support. Support can turn into resistance. So anyway, we got to pay attention to what's going on up here around this 144 level this week. Resistance becomes support, okay? Resistance here has become support. And if this support holds, it will be obviously good for the broader market, but I'm a little leery. Uh, I'm a little leery. I think this move is kind of masking some weakness. And let me explain to you what I mean by that. The way these indices are constructed, it can mask a lot of the underlying conditions. This is the what we just looked at, the SPDR technology ETF. These are the makeups or the holdings. Notice how together Microsoft and Apple are about 47%. So these two stocks dominate the technology industry. Now, why is this important? Well, I think what's going on is a flight to safety. And a lot of times, flights to safety happen right before we get big moves lower in the market. This is exactly what happened at the end of 2021. In theory, think about it. Every other stock in this benchmark or in this indice could be going lower. And if the money's going into these two companies, it could make the indice move higher, the technology indice move higher. So it's masking a lot of what could be deteriorating conditions. In other words, way more stocks can be going down than are going up. But because of the way the indice is constructed, if the money is coming out of those stocks that are going down and going into these two big boys here, well, it's going to make the benchmark go up, but it's also kind of covering up the um, underlying deteriorating market fundamentals. Now, the same thing happened in the end of 2021. Right towards the end, when the market was peaking in December, money was flying into Microsoft and flying into Apple because it's a flight to safety. People perceive, and notice I'm saying the word perceive and not that it is, people perceive these two stocks to be really safe. So people that have money in banking stocks, they're selling their banking stocks, they're putting their money into here. It's perceived to be safer. And like I said, flights to safety tend to happen right before the market makes a big move lower. And that's what happened back in 2021. So let me show you a little bit more here. Okay, so here's Apple, right? Moving higher, resistance around 155. This week, I'm going to be watching to see if this 155 level makes the conversion to support, or if this just kind of turns around and rolls right over. You can see we're getting overbought. Overbought means that we're trading above what would be the typical or historical trading range. And this is important because overbought conditions attract sellers into the market because they assume or they expect a reversion to the mean. And the chart of Microsoft looks very similar, right? We got to see, does this 275 level remain support? I mean, it might be coming support, but we're overbought, right? That's going to attract sellers into the market. Now let's check this out because this is where we got some real signals back in the end of 2021. This is the NASDAQ 100. It's called the Qs, QQQ. You might have seen the commercials. Now this is another indice or benchmark or ETF. Let me elaborate. ETFs are designed to track what we call a benchmark. All right, a benchmark is just an indice. The most popular one is the Dow Jones. Right? There's the S&P 500, there's the NASDAQ. Within those bigger motherships, so to speak, we have these different sectors. So if you look at this, you say, oh boy, this is looking good. We're right at resistance here. Stocks, it's been doing really well. Now this peaked out in late December of 2021. All right, if you want to go back and look at the charts, you'll see that this peaked right at the end of the year, like the last week of December and even early January. Well, this is dominated by Microsoft and Apple. I'm not sure of the exact percentages, but it's huge. It's like at least, it could be half of it. So money is going into these big names. Could be a flight to safety. This could be masking the weakness that's going on in all the other stocks. Now, this is a market-weighted benchmark, meaning the bigger the market weight, the more influence it has on the benchmark, or the bigger the weighting is in the benchmark. Microsoft and Apple, as we have seen, dominates these technology sectors. Now, the next thing I'm going to show you is this. Notice how this is going down. What is going on here? This is the NASDAQ 100, but in this particular ETF, every stock has the same weight. So it's not dominated by Microsoft and Apple. Every stock has the same weighting. You can notice that this is trending lower. Now, back in the end of 2021, when we got right to the peak of the bull market, guess what? This particular ETF peaked in November. It started to go lower in November, and that told us that the market was starting to kind of fall apart. And that's where we got bearish at the stock market jabber. So it told us the market was kind of falling apart. So it was the same thing, right? It was this like flight to safety. People saw that the market was at all-time highs, and the people that are the last people to the party, they're like, all right, I'm going in, I'm buying Microsoft, I'm buying Apple. Other parts of the market are falling apart. Money's going out of there. It's going into Microsoft. It's going into Apple. So it's important that this particular ETF peaked in November of 21. The Qs, which are the market weighted, all right, so let me say again. The equal weighted ETF, where every stock has the same value, peaked in November of 21. The regular ETF, that is market weighted, where the bigger the market cap, the more influence it has on the ETF. Oh my God, I'm watching TV and there's an Invesco QQQ commercial on right now. What a coincidence. So anyway, the market started to fall apart in November, right? But because of the way the benchmarks or these indices are constructed, it didn't seem that way to those who don't understand this because, oh, the S&P is still moving higher. Oh, the Qs are still moving higher. Everything is great. They don't understand that the way these benchmarks are constructed could hide the weakness that's going on. And that's exactly what happened. And that could be going on now. So most of the stocks in the NASDAQ 100 are going lower. It could literally be, I mean, it's got to be more than this. I'm using a little bit of hyperbole here, but It literally could be that the money is just going into two stocks, Microsoft and Intel. I mean, sorry, Microsoft and Apple. And that makes the broader benchmark look like it's going higher. But we can see here, most of the stocks in the Qs are going lower. So technology is holding up the market, but it's a flight to safety. And when flights to safeties happen, they could unwind really quickly. So this is what we need to watch this week. So make sure you check back, and make sure you please subscribe to my YouTube page here. I'm trying to get up to 1,000. We're at about 499 now. All right, I want to get to 1,000, so help me out. I would appreciate it. Okay, let's move along here. So let me just summarize. The move higher in tech that is holding the market up could be, and I think it is, a flight to safety. Flight to safeties happen a lot of times right before we make a big move lower, and that's what happened in the end of 2021. So now here are the financials. Okay, so I said it's a tale of two markets. Tech is going up, financials are going down. There's 11 sectors in the S&P 500, and financials are one of them, and technology is one of them. Now look at this, right? Massive selling because of this the banking crisis. And we can see here, just a little aside, resistance becomes support, right? We talked about seller's remorse. People sell, it goes higher, they tell themselves they're going to buy it back. If you have enough remorseful sellers placing buy orders at the resistance level, well, it can turn into support. Here, support becomes resistance. If you have enough remorseful buyers who bought here, who regret buying when the price goes lower, if enough of them are placing their sell orders at the level that was support so they can get out of break even, the support converts into resistance. So we can see this on a lot of charts. It's just a fundamental principle of markets. And if you look at a chart through the context of what it does tell us about supply and demand, what does this tell us about investment psychology, it makes it easy to understand. So we had a little bit of a move up on Friday, but notice how there's the support here, and where do we run into resistance? Right at the levels that we're support. I spent more than 20 years in the institutional trading industry, and I will tell you this: the good traders don't worry about silly things like Gann theory or harmonic charts. They worry about, or they focus on, what are the important levels, what's the momentum, what's the psychology. And I can speak with authority because I did that for half my life. Anyway, the fact that, even though we had an update, this is still in a downtrend, right? Notice how Friday's closing price was still lower than Thursday's opening price. Still in a downtrend. And this all goes to the banks. And if another bank or two goes under, well, I think we could get some pretty significant selling in the broader market, and the flight to safety could unwind. So here's our banking ETF, right? We have on the very top, we have the S&P 500, then we have 11 sectors, and within the sectors we have industries. So the banking industry is part of the financial sector. This is an interesting chart here too, because it shows us that these levels that are important can retain their importance for a long time. This level 35 was resistance back in 2020. Here we are 3 years later, and it turned into support. Okay, at least for now, or over the last couple of weeks. Remember, resistance levels can become support. Seller's remorse can turn resistance into support. And this shows us a concept that we call market memory. The levels that are important can retain their importance for a long time. It could be months, and then in this case, it could even be years. I've even seen levels that were important literally for decades, right? If you look at Bristol Myers, I don't have a chart of it, but it peaked out at the exact level, well, within a dollar or two in 2015 that it did in 1999. So, all right. So I just want to emphasize how important these levels are, right? We could see here this level was support for whatever this is, 44 for almost 2 years. Levels, trends, momentum, and psychology. That's what I want you to focus on. And if you focus on those, that's when you're going to start to make money, right? Trading is not about coming up with some super secret elaborate system that's always right, because they don't exist. Trading is about understanding market fundamentals, and I don't mean fundamentals like price to earning. Well, sometimes that could be like a stock fundamental, but I mean market principles. Some levels are more important than others. The importance can last a long time. Resistance can turn into support. Support can turn into resistance. Here's just a closer view. Now, this kind of concerns me. Why? This is showing what we call bad action. And what I mean by this is, all right, we get this banking crisis, a couple banks go under. The government's like, all right, we're going to do this. We're going to backstop. We got Powell. We got Yellen. I mean, I don't even know why these people still have their jobs, but no one that I talk to in the institutional trading community, none of my friends are like, it's basically a joke. No one really listens to them. They've ruined their credibility. But you would think that after this big sell-off, if they're making all these moves to prop up the industry, why isn't the ETF rallying? Why is the sector not rallying? As a matter of fact, it's continuing to go lower. So listen, I'm wrong. I can be wrong. Powell can be wrong. Yellen can be wrong. Anybody can be wrong. But the market is never wrong. And right now, what I'm seeing is, despite all these things that are going on, there's still some pretty significant weakness in the in financials and in the banking. And here's our support level, around 35. If this breaks, we can make a pretty significant move lower. The reason why is this, right? Support is a large group of investors who are looking to buy at or around the same price. In this case, it's 35. If we get below that, it tells us something. Remember, we got to look at every chart in the context of what does it tell us about supply and demand. If it gets below that, it tells us that the investors who created the support with their buy orders have left the market. They've either canceled their orders, they finished their orders, but anytime you take demand or buyers out of a market, it could set the stage for the sellers or the supply side to push the prices lower. It's just basic economics 101. If you can understand how supply and demand, you can understand how to read charts, okay? It's not as complicated as people seem to think. It's just keep it simple, stick to concentrating on what these principles are. But to me, this is bad action. So in the tech sector that's going up, we got the flight to safety, and in the financial sector is still going down despite all these moves that are supposedly supposed to save it. So those two things right there leave me a little bit kind of worried. I mean, not that I'm worried. I mean, I don't want the market to go down. There are ways to profit when the market goes down. You can just buy inverse ETFs. This is something we talk about a lot. In other words, there are ETFs that are designed to move in the opposite direction of the market. If financials go lower, there's ETFs that are designed to go higher. And I've spoken about that before. You can see that in some of my other videos. Now this is the banking. All right, yeah. So, all right. Anyway, so here's our bank industry, right? Trending lower, a little bit of a move up on Friday, but really not enough to make me think that things have turned. You would think that with all these moves, this should be going higher. Think about this. This is a good example of bad action. Assume a company reports their earnings and they're way better than estimated. Well, and the stock goes down. That's an example of bad action. The market acts different at different times. If a market's in a bull market and moving higher, a company could miss their earnings and the stock could go up. If a market's moving lower, a company could beat their earnings and the stock could go down. So we can get a lot of insight out of what we call market action. It's not quantifiable, but it's something that the good traders pay attention to. So you would think that, oh, okay, all right, well, hey, listen, we got this big move lower. The government's coming into the rescue. They're doing the backstops. They're doing the bailouts, whatever you want to call it. All right, well, maybe some pundits think that that's important and positive, but the market doesn't seem to, and the market knows all. So we have this little bit of a move higher here. It's, I don't know. Not enough to convince me that the trend has changed. And here's our First Republic Bank, which is one of the primary culprits, I guess, in this whole thing. Despite all the moves to come bail them out, we're trading at the lowest level that we've been at since this whole crisis started. Right? Does this look like something that's being saved? If it was, we would probably see a move higher. All right, let's go. We got one more chart here to look at. And this is just Bank of America. As we can see, this is another example of resistance becomes support. The reason why I wanted to show this chart is because it's got this ascending triangle here. Now, I don't pay attention to too many patterns because I think a lot of them, frankly, aren't valid. But an ascending triangle, these tend to be pretty good. Up here around this level, we got sellers, and they're kind of just holding their line. They're okay with waiting for buyers to come to them. But down here, we can see we got this higher lows, right? This ascending line. Markets go in peaks and valleys. They don't go in straight lines. And when the valley is at a higher level than the prior valley, we call that a higher low. So this tells us something. Remember, you have to look at these charts through the context of what does it tell us about supply and demand. This tells us that we got complacent sellers that are just kind of ready to chill and wait for the buyers to come to them. And we got buyers who are getting more and more anxious. They're getting more and more antsy. They're willing to pay higher prices. So this combination of complacent sellers and aggressive buyers could set the stage for the price to move higher. And once again, we got the market memory. Resistance here became support here 3 years later. All right, everybody, so that's it. So just to summarize, tale of two markets, technology moving higher, could be because of a flight to safety, which tend to be a bearish indicator. We got the financial stocks moving lower with no sense of a rebound despite all this government intervention. That's bad action. All right, so bad action in financials, flight to safety in tech could set the stage for a move lower. All right, everybody, thank you so much. Make sure you check back with the stockmarketjobber.com, and I will talk to you soon.